Hello there. Welcome back to Grade 10 Accounting. This video, we want to look at the preparation of the note of fixed, note of fixed assets. That is the fixed asset note or the tangible asset note. So this is the question that we want to look at. So our question reads: the following information was extracted from the books of Mickey Toys Shop for the financial year ended 30 June 2017. The non-required part, we are told that calculate the depreciation on vehicles on 30 June 2017, whereby it has 5 marks. So on 4.2, it reads calculate the depreciation on equipment on 30 June 2017. With also 5 marks. And then we go to 4.3, prepare the note on tangible fixed assets on 30 June 2017 with 10 marks. So we're only going to concentrate on 4.1, 4.2, and 4.3 according to this video. So we go to the question, try to see information given in the question. Now we can try to go to the next page where we get the information. A is some balances on 1 July 2016 in the general ledger. These are the balances that we are given. Then information B, the following transaction involving tangible assets took place during the year. So we've got other transactions that we have according to the year that we are following are in point form. And then this is the information that we have now. So we want to respond to the first part of the question, which is 4.1, which is saying calculate the depreciation on vehicles on 30 June 2017. So our year is ending on 30 June 2017. Very important to note. So you can try to bring down the financial year where it's starting, where it's ending. It's gonna help you when you are now making proportionate calculations in terms of a number of months, maybe that fixed asset stayed in the business. So we are going to say it ended 30 June 2017. So it means it started at the previous year, the following day, which is from 30 June, we go to 1 July. So we've got 1 July 2016. So this is our financial year. That's how it is stretching from 1 July 2016 to 30 June 2017. So very important. So we go to our information part now so that we can calculate depreciation on vehicles. So we are being told that the word balances are there on 1 July 2016. That is at the beginning. Remember, our year is starting on 1 July 2016. So this information that we are given of balances is on 1 July 2016. So it means this represents our opening balances. So having that now, we can now be able to see in terms of vehicles, we've got 190,000 at the beginning of the year. Then if you go to additional information, we see that we want to see if you've got additional vehicles that came during the year. If you go through remember this additional information, you have to read it before you start to answer the question so that when you're answering, you can easily go to areas that are required. So here you see that vehicles is mentioned on point number 2. On point number 3, this one, that's where we have got our vehicles. We're saying a new vehicle was bought on credit from AA Motors on 1 October 2016 for 160,000 and recorded into the books. So what it means is we have one edition of vehicles that is on 1 October 2016. So obviously the first thing is to calculate the number of months that we had that vehicle in the business. That is from 1 October until the end of the financial period. So we are now saying the whole of October, the vehicle was there. Then November, December, and then we've got January, February. Then our year is ending on end of June. So we are saying June, and we are saying October, November, December, January, February, March, April, May, June. So we have got 1, 2, 3, 4, 5, 6, 7, 8, 9. So this vehicle was there for 9 months. So we want to calculate the depreciation, and we are told that depreciation is written off on vehicles at 15 per annum on costs. So this is the straight line method, on which is the cost method. So basically, we are going to say our 15% of 160,000, then we get the depreciation for the whole year. Remember, it's per annum. And then we make a proportionate of 9 months that vehicle stayed. So we're going to multiply by 9 over 12. So this is exactly how we're going to present it on the other section. So we go there and try to see what we have in terms of the other section here. Remember, this is a new vehicle. This is a new vehicle. So let's try to see. Then we can as well try to calculate it. We are now saying depreciation. Depreciation of new vehicle. Remember, this is just new vehicle. Remember the depreciation that we are going to Here for the year is going to be the total depreciation. So here we just want to calculate depreciation for the new vehicle that was there, and then we can now calculate for the old ones that were there in the business. So basically we are saying here 15% is 15 over 100. We're going to say 15 over 100. We multiply by the cost of that new vehicle that was purchased. 15%, and then multiply by 160,000. Then multiply by 9 over 12. So here we are saying times 160,000 over 60 over 1, then multiplied by 9 over 12. Was this vehicle was there on the business for 9 months. So we calculated the size. We are going to get your 18,000. So you are going to get your 18,000. So this is the depreciation for the new vehicle for the 9 months that it stayed. Then we've got depreciation of old vehicles. So basically what we are going to do there is that we are going to find out about the old vehicles value at the beginning. Remember, this is the cost method or straight line method. And a straight line method, the formula for calculating depreciation using straight line method is percentage times cost. As simple as that. So we're just going to identify the cost at the beginning. That is the cost price at the beginning represents the cost of the old vehicle. So we have got 190,000 here. So basically, we are going to say 15% of 190,000. So you come here. You're going to say 15% is 15 over 100. Then you multiply by 190,000 over 1. You do that there. And you know that these vehicles were there the whole year because they were there at the beginning of the year. So they were there the whole year. So the number of months that they stayed is 12 months over 12. Basically, we are saying 1 year. And then we calculate it as such the answer that we are going to get there. Let's try to see if you calculate it correctly. 28,500. So this is for the old vehicles. Then what we need is total depreciation for vehicles. Total depreciation for vehicles. So we are saying depreciation for the old plus the new. So for the new, we have got 18,000 here. Then we add for the old 20,500 to get the total. So we are saying 18,000 plus 20,500. And then we are going to get your answer is 46,000. 46,500. So this is exactly what we have. Then we try to go to the second part of the question, which is saying total calculate the depreciation on equipment now. So on equipment, again, we are going to do the same. We go to the list of balances at the beginning. You are told that equipment at the beginning, the cost of 56,000. And we can go to Excel information to try to see what is it saying about equipment. Equipment is here. They bought computers and printers for office use for 20,000. On 1 March 2017, installation cost of 2,000 was paid by check. So these installation costs are capital costs. They represent capital costs. So the capital cost increases the value of the non-current asset or the fixed asset. So we are saying 20,000 that was the cost that was the cost for that for the computers and printers that we bought with, plus the installation cost will give the total the valuation after we've included the total cost. So the new cost price will be 28,000 plus 2,000. Then we get our 30,000. So basically we are saying 28,000 plus our 2,000, and then you get your 30,000. So 30,000 is the cost of these new computers and printers that we bought. So on the method of calculating depreciation, we're told it here that equipment was 10% per annum using diminishing balance method. So basically, that's how we are going to calculate it. So let's just try to see. Let's just try to see how we can calculate that one. we know that when using the straight line method, we are going to using the straight line method, we are going to. So we are saying straight line method. Sorry, this is diminishing balance method. Sorry, diminishing balance method. We are going to say percentage times your carrying value. So this is exactly how we calculate depletion using diminishing balance method. But then the carrying value, again, you need to first find the carrying value, whereby the carrying value is equal to your cost minus your accumulated depreciation. Exactly, it's as simple as that. So we need to first calculate the carrying value first. Then when you get the carrying value, then you say the percentage that you are given. In this case, we are given 10%, then you say 10% times the carrying value. But we can start by calculating a new equipment, depreciation of new equipment. So we can just say here, depreciation of new equipment. Depreciation of new equipment. So depreciation of new equipment, we are just, first of all, remember, this is new equipment, so already there's no depreciation for that equipment. It's starting to be bought, starting to enter the business. So what we are saying is we are just going to try to see when was that new equipment bought. So if you come here, you'll see that it was bought on 1 March 2017. 1 March 2017. Remember, the year is ending end of June. So we are saying the whole of March, April, May, June. So 1, 2, 3, 4. We have got 4. So this equipment stayed for 4 months, and we already calculated the total cost, which is 130,000. So there's no depreciation. So the cost minus accumulated depreciation will give you 130,000. The cost is 130,000. The accumulated depreciation also is 0. So it's going to be 130,000 minus 0, and still you get 130,000. So you're just going to use 130,000. Then you multiply by the depreciation rate, which is 10%. So we go there, I'd say just 10% of 130,000. So we are saying 10%, which is our 10 over 100 times 130,000. And we are going to get your 13,000. So this is the depreciation of new equipment. And then this is per year. Remember, the rate that we are given here is per year. So we need to make up a proportionate of the number of months that it states. Remember, we counted the number of months, and we got what? We got our 4 months. If you still remember, let's just maybe try to go back and refer back to the number of months that we have. And the 13,000 is representing the annual figure. So we need the proportionate figure for the number of months that the new equipment stayed in the business. So if you come here, you'll see that we counted here, we got 4. That the new equipment was bought on 1 March, then we counted March, April, May, June, and there were 4 months that are there. Then obviously the answer that you got there, you make a proportionate calculation of 4 months, whereby we're saying times 4 over 12. And obviously 13,000 times 4 over 12, you're going to get your, let's just try to see. This one, if you say, let's try to see. Depreciation of new equipment is not 110,000. I think there is a mistake that is there. Remember, we said 28,000 plus 2,000, then we get to 30,000, not 130,000. So here there is a mistake again that we need to address. 30,000. So this 30,000 is also going to be here. The answer that we are getting is 30,000. Was here is 10,000. So the answer that we get there is going to be 3,000. So 3,000. Then you multiply by 4 over 12, you're going to get your 1,000. So this is depreciation of new equipment. Then we need the depreciation of old equipment. Depreciation of old equipment. So here we're saying depreciation of old depreciation of old equipment. So depreciation of old equipment, what we are going to do is we are going to use the formula of diminishing balance, which says percentage times carrying value. So to calculate carrying value, we are also going to say carrying value is equal to cost minus accumulated depreciation, like what we said. So let's start by calculating the carrying value. So we go at the beginning of the year, the balance that are given as our opening balances, and then we calculate a carrying value. We are saying equipment are in 56,000 costs, and then accumulated depreciation for equipment is 5,600. So 56,000 minus 5,600. So here we come here. So we are saying 56,000. So our carrying value is equal to 56,000 minus 5,600. Then we are going to get your carrying value as, let's try to calculate it as such here, 56,000, and then we subtract 5,600. And then we are going to get 50,400. So it means here, your amount is 50,400. And then this is the carrying value. Now we are saying percentage. Our percentage is what? Our percentage is 10%. So we are going to say our depreciation now is equal to 10 over 100, which is 10%. Then we multiply by 50,400 over 1. So we calculate it as such. We are going to see that the final figure that we are going to get there will be 5,040. So this is depreciation for all the equipment. And total depreciation now, we are going to say the depreciation for old equipment plus depreciation for new equipment. So depreciation for new equipment, remember I calculated it as 1,000 here. 1,000 is here. And then we want to add it to the depreciation of old equipment. So total depreciation now we are saying, here we are now saying total depreciation is now 5,040, which is for old equipment plus 1,000 for new equipment. And then we are going to get your answer as 6,040. So we now have these figures as our total depreciation for the year. This one is for equipment. Then I will go to this, the second part of the question now. So on the other part, which is the third part, we are going to prepare the note on tangible assets on 30 June 2017. So we can just maybe go to the other section and see the note that we are going to fill in as given in the other book. So we can just try to come here. So we are here. We've got some figures that are pre-entered in terms of carrying value at the beginning, and then those are the figures that are pre-entered on the note. So those are the only figures that are pre-entered on the note. So what we are going to do is we are going to enter the cost at the beginning, and then accumulate depreciation at the beginning. Those figures we have them. We are just taking them from there. We start with land and buildings. Land and buildings at the beginning. Right, we go there to the question and see that land and buildings at the beginning at 240,000 is our cost. And you know that land and buildings does not depreciate, so depreciation is going to be 0. So we leave it like that, and then we calculate as such. So we come in. We are saying our cost was 240,000. And depreciation was new because we don't have anything in terms of land and buildings. Land and buildings does not depreciate. Then we go to vehicles and see the balance at the beginning. Right. Vehicles, we've got 190,000 representing our costs, and we've got accumulated depreciation being 28,500. So we are going to enter as such. So at the beginning, we just take the figures that we are given. So land and vehicles, we are saying we have got 190,000. And then in terms of depreciation, we've got 20,500. And then obviously we subtract here, say 190,000 minus 20,500. and you gain 161,500, which is the figure that's pre-entered. Then you go to equipment, you do the same, you go to the at the beginning of the question. And see what we have in terms of equipment. Equipment, we have got a cost of 56,000 and accumulated depreciation is 5,600. We're going to enter as such. Right, we come here. Right, on equipment, we are here, we are saying equipment, we have 56,000. Then accumulated depreciation was 5,600. In such a way that if you say 56,000 minus 5,600, you're going to get your 50,400. And then we come to the movement part, where we are going to have our additions. Remember, in each and every section, we're going to have additions. On vehicles, we have additions according to our calculation of depreciation. And then for equipment, also some additions. So we are going to pick those additions, and then we come back and enter the additions. So let's just go back to the question. Yeah. So we'll start with the landed buildings. Point number 1 is saying extension was done to the shop to the value of 50,000 rands and repairs to buildings 15,000 rands. AD Builders was paid by check on 15 January 2017 and it was recorded in the books of the business. So we are going to consider our 15,000 as a revenue expenditure. This is the revenue expenditure. And when it's a revenue expenditure, it doesn't increase the value of the fixed asset. Remember, the extension was done for 50,000. So the extension is a capital expenditure. So it's going to increase the value of the land and buildings. So we are going to add 50,000 as a capital expenditure. But revenue expenditure, we don't add it. We are not going to add it. It's a revenue expenditure. They are repairs. So we are redoing the building that was there. So we are not going to add it to 50,000. We are only going to consider 50,000 as a capital expenditure. Then the same thing that we did when we are treating our equipment, we added the 2,000 because 2,000 is a capital expenditure. We have to add it to increase the value. So here the capital expenditure is 50,000. So we are going to add 50,000. That's the addition that we have. Then for equipment, we've got 10,000, which is 20,000 plus 2,000. 10,000 is addition. Vehicles, we've got 160,000 is addition. So those are the additions that we have. So we can go there and put those additions. So we are here, we are saying we have 50,000 for landed buildings. We have got 160,000 for vehicles. For equipment, we've got 30,000. So this is what we have in terms of additions. Then depreciation, obviously, for landed buildings, there's nothing. But for vehicles, we did calculate it. We can just refer back to our calculations. We know that according to our calculations, the total depreciation for vehicles, we got 46,500 for vehicles. Then for equipment, we can check again. For equipment, total depreciation is here, 6,040. So we're going to enter those figures. There is our depreciation for the year. Right, we are here. So we are saying for a depreciation for the mid-row one, we have the vehicles. We have an amount of depreciation. We have 46,500. Then for equipment is 6,040. Right. So what we are going to do now, we are now going to the carrying value at the end of the year. So we leave it because to get the carrying value, you have to say cost minus cumulative depreciation. So to get the cost at the end, we are going to say 240,000 is cost at the beginning plus cost exchange of cost. So it's 240 plus 50 to 290. So you're going to get 290,000. Then for accumulated depreciation at the end, we're going to say accumulated depreciation at the beginning plus depreciation for the year, then we get accumulated depreciation at the end. In this case, we've got 0, 0, so also we are going to have a 0 here. Then we go to the second part, vehicles. Cost at the beginning, we have 190,000, and then there's an addition of cost of 160,000. So we're going to 190 plus 160, whereby we are going to get a total of 350,000. And then for accumulated depreciation, we are going to say at the beginning 20,500 plus depreciation for the year 46,500, and we are going to get your 75,000. And then do the same thing to equipment. Cost at the end, we are going to say the cost at the beginning 56,000 plus 10,000 that we introduced, and then we are going to get to 86,000. If it is, get 86,000. Yes. Then depreciation at the end, accumulated depreciation at the beginning plus depreciation for the year 6,040, and you get 11,000. 11,640. And of course, accumulated depreciation, you have to subtract it to that you get the carrying value at the end. So basically now we are now saying, but for landed buildings, it still remains 290,000 because 290,000 minus 0 get 290,000. 350,000 minus 75,000, we are going to get, let's try to see if you say your 350 minus 75, you're going to get 275. Is your carrying value at the end. 86,000 minus 11,640, you are going to get 74,360. So this is the end of our question. We now have our carrying values for all the non-current assets that we have. So given that you are supposed to prepare the balance sheet, it means you're going to add 290,000 plus 275,000 plus 74,360. Then you get the total carrying value that is going to go under the fixed or non-current assets. So this is what you guys are putting in this video. Let's subscribe and share. Let's share the link to all our colleagues who are doing retained accounting. Let's click the notification button so that whenever we upload, we get notified as we prepare for exams. But as for this video, I'm signing out. We meet again.